Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. And the talking point today, as also probably for the next few days, is how to navigate through what what one would argue is not just a volatile period, but also a period with a fair possibility of a downdraft. And to talk about how is he telling all the institutional clients at HDFC Securities to do so, we joined by Unmesh Sharma. He's head of equities at HDFC Sec. Unmesh, great having you. Thanks for joining in.
No, thanks for having me, Neeraj. Thank you.
So, Unmesh, what's the 50,000 feet view? Is there a higher probability of a downdraft, or do flows indicate that India might? I mean, even if India does better, will India still succumb to pressure?
Okay. No, thanks for the question. And there is, given that it's at 50,000 feet, there is a lot of cross current going on, right? So let me answer the short question, which is that do I see a downdraft from here? The answer is yes. Now, how does it all play out, right? Because it's not simple, because what tends to happen is that we tend to focus on one headline, but it's actually a mix of everything that's going on. Look, let's start with the positives, right? So one is that relatively, as compared to any other time in history, especially if you look at what happened during the taper tantrum of 2013, India's fiscal situation is much better. External vulnerability is much lower. On a relative sense, if you see Indian companies much better capitalized, banks are in good shape, right? So in that context, is India relatively better? Answer is yes. Having said that, what happens is that of course, there is one very big factor, which is that since 2016, we've seen a continuous inflow of mature retail domestic money coming into the Indian markets, which has actually gone through a lot of ups and downs, but remained fairly steady and in fact on an upward trajectory. That's actually a very big sign of maturity. If someone had asked me in 2016 that we'll see $50 billion of outflows from Indian markets, from FPIs, and the market is not going to budge, I would not have believed it myself. So in that context, India in a relative sense seems quite good. But at the same point in time, what happens is that the storm is actually of a much larger scale and is actually happening at a global level. The first, I think, is the fact that we believe incrementally there is going to be a problem for long duration assets. What I mean by that is that if you look at the Fed, okay, rates are going up. I think there has been consistent negative surprise on that. The second is that, we called, at HDFC Securities, our research team got it right. We said that inflation is going to become a problem. It is going to last longer, which means the fight against inflation lasts longer, which is what has started to play out as well. Now, in this context, what we believe will happen is that rates stay higher for longer. That creates a problem because you see what happened to the dollar index. It's at 114, 115 now. That's a serious headwind for all emerging markets. Right? On top of that is the big elephant in the room, which not a lot of people are talking about, which is the fact that there is quantitative tightening. And while it started in June, for the first 3 months, you had not seen any effect of that. The last 2 months have actually accelerated. And to some extent, you can see the liquidity getting sucked out from our emerging markets, including India as well. That is the second part of the problem. The third is that if you put all this together, now one big new factor which has started to play out is that the coordination that we were used to among central banks globally, which started in 2007-8, when they started to fight the global financial crisis, are broken down. So if you see, China is on its own trip, the Japanese are on their own trip, the European Union is facing its own problems, the entire country of UK is going through its own issues with the change of chancellor and whatnot. And then the Fed has its own agenda, and so does India. So what we are seeing is that volatility remains very high. Now, to pay for all this, you should typically have a market which is one standard deviation below mean, which is when you start to get comfort. But the market's actually the other way around. It is more than one standard deviation above mean. Would you pay this kind of entry multiples to enter the market long term? It feels like that's not the right number. So while we believe in staying invested into markets, we don't think that this is absolutely the right entry point.
I want to counter question this. I know it's difficult to time the market.
Yeah.
I know it's virtually impossible, let's put it that way, to get it down to the T. But here's the point, right? When there is a higher, you play odds, right? If there's a higher probability of a downdraft with all that you've spoken about, why does it make sense to stay invested? Why not sit on some gunpowder to tactically take advantage of lower levels, because you are eventually playing odds and a hypothesis, right? That's what investing is about.
Yeah, so Neeraj, there are two ways of looking at this, right? Even if you look at the worst market in 2008, which was the worst market at least that I have seen in my career, 20 years plus, right? In fact, I think it was worse than 2001 as well. I think what I would say is that you'll still find a few hundred stocks which make money, right? Okay, and well, I had institutional equities. We are an active broking house, right? From that perspective, our job consistently is to make money for investors. Now, in that context, how do you play that, right? One is that, and at the same point in time, I would also, in a lighter moment, also say that, look, we also acknowledge that there is a possibility that we may not be right.
Of course.
Okay. And on top of that, the biggest factor is that, to be honest, and I acknowledge one of the mistakes we made, which is to underestimate the power of the retail investor incrementally coming into the market. Now, just, I'll flip the argument around. Just like you said, we can't time the market. Exactly, we can't time the market. So what you have to do is to stay invested. Okay. What do you do? Our model portfolio is at 3% cash. So, we generally don't go higher than that. We've gone to 5, but that's like very, very short term. But generally, we are at 3% cash. So that's okay. On top of that, how do we deal with this? We have a very strong bias towards 3 key things, right? One is value. Okay, this is something which has come back, I think, after 20 years. I remember there was the obituary of value was written so many times in my career as well, but then it just keeps coming back, right? Now, we define value as cash flows, not as earnings or a book value. So there is value still sitting there, at least on a relative basis, right? And which is why if you see our model portfolio, it's underweight staples, it's underweight most discretionary names, right? It's underweight a lot of the energy names, NBFC, small banks, stuff like that. What you instead do is you look at rock solid companies, okay, from 2 perspectives. One is that who will go through the cycle and come out on the economic side fine on the other side, right? Long-term thematics like capital markets, insurance. These are not things that we expect anything to change. Can they see a dip down in valuations? Of course they can, but then you would want to continuously stagger your investments in during that time, or gas for that matter, right? There are very, very good plays, Indraprasth Gas, Gujarat, all these are in our model portfolio. You see the way in which we think that will happen. And I think the third biggest factor, which is kind of linked to what I was saying first, is that the fiscal situation of the government is in good shape. Okay. In that context, we continuously believe that economy facing sectors are going to do well. If you see, our last 10 thematic reports, I don't know if you had a chance to, if your readers have, had a chance to look through. We write very, very long-term thematic views. And 3 of those were focused on things like PLI, Atmanirbhar Bharat, and most recently the Capex report. Okay. You put that into context, our big call for the year, which has been there for the last 3 months, this is what Varun, my head of research, keeps saying, industrials over consumer is the theme for the next 12 months. Now, one way of thinking about a market is going down, should I wait and enter later? The other thing is that if such a large phenomenon is happening in front of you, probably, a changing, a turnaround, a milestone is happening, you might as well participate in that. So in that context, we believe that if you look at it from the 12 months perspective, the push from the government, starting from the Prime Minister's office all the way down, and we feel it, right? We do a lot of government interactions. We are seeing it happen. We believe, this is a giant machinery. It moves at its own pace, but at the same point in time, there is some momentum which is there in that theme.
Okay, and I'll just come to the theme in a moment. In your answer, you mentioned the possibility of what if you are wrong in your thesis or a belief of a higher probability of a downdraft. What could actually cause that to happen? Because currently, external environment, you don't see too many probabilities of that in the near term, unless an mega event happens. I mean, if post November, if the political pressure or the political leaning on the Fed is not as high, or China revives or something else, right? So my question to you is, what could cause this downdraft possibility to get negated?
Yeah, so look, there are a couple of things which currently are still going against the negative thesis. Okay. And one of them is the fact that if you look closely within the US, the central bank and the politics not necessarily 100% aligned. This was not the case around 6 months ago. The biggest factor being, you see the student debt forgiveness that has happened in the US. Okay, we are not experts on the US economy, but what I read and what our economists in Delhi, in HDFC Bank are saying is that it could push in $400 to $600 billion into the market. Now, the quantitative tightening for the last 2 months has been 130 billion, if I'm not mistaken, which means that there's a net inflow, right? Now, it makes the job of the Fed that much tighter. That's not my problem, right? But at the same point in time, what happens is that currently there might be on the margin a net flow going out. Okay. Second, so that's maybe in the short term positive for risk assets. Okay. Second, and very importantly, oil's coming off. It goes up and down, but generally it's in the 80s now. So what that does is that in a market which is searching for yield, which is looking for places to invest, India and all generally countries which are consumers of oil and gas or net importers of energy tend to benefit in the short term.
That's true.
The market may think, okay, that let's continue to invest in India for the amongst in Hindi they say "Ando mein kana raja," so why don't you put some money in this and see what happens, right? Now, the third factor is that there is an anecdotal feeling, okay, which I've seen amongst emerging market investors, that generally you don't want to be heavily overweight China, even though relative value it looks better because valuations have come off. Now, I may be right or wrong because this one is difficult to call. The mood changes like every month, right? In this kind of context, if you look at the emerging market basket, assuming money is coming into emerging markets, the emerging market basket today, India, along with Taiwan, on certain days we are even bigger, is the second largest weight, and it's actually gone up. So it's become a very important market from that perspective. So if you want to keep money in emerging markets, want to be underweight China, you end up putting money into India. So there's a little bit of that. Now, is this my base hypothesis? Answer is no. That's not what I'm saying. The point is that this is a risk that we run in the short term, that flows could continue to remain like this, and hence the last one, okay, which is the longer term negative, or rather the positive on the market, and hence risk to my negative thesis, is the fact that at the end of the day, we do not think that there is any intent of the Fed to cause anything more than a shallow recession which achieves price stability. Okay. What I mean to say is that even if things go very bad, at one point in time, we are not in a situation like 2008 or 2020 or 2001, where the financial markets will cause a crash in the general economy. We are not in that. We are in a recessionary environment. We are not in a dislocation, so as to speak. So the problem in the financial market will not spread to the economy. What that effectively means is that at some point in time, the Fed will say that, look, our broad, and it may happen even before they reach the 2% goal, right? They may say, look, broadly, we seem to have achieved
2% is far away. So
it's too far away.
To happen before.
Yeah, it has to happen before. And they may say that, the economy is suffering too much. Okay, there may be enough political pressure. They may just, slow down. So currently, if you look at the dot plot, the view earlier was 3 months ago was that rates will start to kind of come off at end 2023. Now it has moved to 24. Who is to say in 6 months from now it comes back? The other is a lot of the base effect issues, especially related to the war, are now going to come into the base now. Because do note that actually, while the war started early this year, the inflation spike had started to come from November last year. If you look at the data, it actually was not straightforward. What that effectively means is that from November onwards, some of the numbers may start to improve on their own. So it may give some kind of false dawn hope that things are kind of getting better. So let's see, how this goes. But it's be volatile. It's not going to be straightforward. It is not one of those things.
Okay. Fair call. So despite the fact that the yields, and there is an alternative to equities, there are yielding assets other than equities, which are yielding risk-free rate of return, which is much better. Because of the fact that the timing the market is difficult, you are positioning yourself in defensives in certain spaces, which will probably fall less and will recover faster. I'm guessing that's the thesis around equities.
Yeah.
Okay. So let's talk about some of those themes as well. So I did go through your Capex report. In fact, that's probably one reason why we thought it'll be lovely to do this conversation with you. Enough and more sound bites out there from companies which are feeding into this capex or benefiting from this capex, saying that this is the kind of demand that they haven't seen in a really long time.
Yeah.
But the punchier or the really high quality assets, Unmesh, as I look around different themes which benefit out of this, are almost priced to perfection, if you will, at least on the earnings basis, if not the cash flow basis. So now enlighten us on a cash flow basis. Where is it that you find favor within this whole wide bucket of capex beneficial?
Okay, so look, this is a quandary that we are facing as well, right?
Achha, okay.
Okay, so this is not straightforward, but at the same point in time, let me try to answer this, right? So look, are we convinced this is a multi-year cycle? Answers yes. Okay, that's the starting point. Now, we've seen this happen in the same sector in 2001 to 2008. More like 2005, 6, 7, 8, where we felt like we are going through a big capex upcycle, and everything got kind of priced for that. Now, if something's 30 times earnings, but if there is a risk to earnings upgrades, then it's not 30, it's 20 or something like that, right? Now, what's happened is that there has been a hiatus in capex for 10 years. And that's what the data is saying. So if you read, in fact, that's the first line in our report, that after a hiatus of 10 years, we have now come back, right? If you read the capex report, what we are saying is that if there is a 10-year cycle which is reviving, and on top of that, there is such a strong push from the government, and we believe there is a very serious, there is a lot of seriousness on this. This could be a multi-year cycle. Now, if a year or two of that is priced in, that's not ideal, and which is what my starting point was, that the market's still quite expensive, but at the same point in time, on a relative basis, that is still something that you would want. Two reasons. One is because the great thing about capex, and this is something that a lot of newer investors have forgotten in this age of new age technology where everything is making a loss, right? Because you're all betting on what will happen and you have no clue where the revenue is going to come from. You don't know when the profits will come. Is that capex is typically a multi-year cycle. So the moment it gets announced, you have reasonable visibility on where it will go. You can debate what will happen to traffic. You can debate what's happening to demand. You can debate whether we'll export or not export. All of that is possible, but you know that the capex is coming. The second very important thing is that very often, of course, this is not always true, but generally, if you are backing the right management with a good track record, whom you can trust, then you have to understand that they're putting money on the table. This is not the old days where equity infusion by corporates or by promoters into companies was very little. The banking sector has changed completely since 2015. So if you look at, in fact, this was one of the things that was told to me when I joined in 2017, HDFC Bank, Mr. Puri was still there. He said that, look, I was an equities banker, right? So they would say that, the relevance of equity markets in that sense has gone up because unlike the previous two cycles of large capex, this time the banks are actually going to ensure that there is a lot of skin in the game from the promoters. Unlike 2015, where it was easy to kind of go bankrupt, dump the assets and walk away. If you look at the way in which the government has formed all the new, there will be slips. Okay, let's not assume it's a perfect world, but at the same point in time, to a large extent, there is a push from the government as well as from the banks to ensure there's enough equity in there. What that means is that the skin in the game for the promoter is there. So if a capex gets announced on a management that you already like, okay, the probability that it actually will play out because they have some visibility on demand is higher. So it's a little easier in that sense to invest in long-standing projects, long duration projects in infra as compared to the new age technology sector, and which is why we don't mind paying a little bit extra if that is the only way to get into the game. I'm sorry for the long-winded answer, but what we are trying to say is the visibility is better.
No, thank you for that long-winded answer because it explains your thesis. My question only is, are you paying a little bit extra or are you paying a lot extra? On the earnings basis, it seems a lot. So that's why I'm trying to
get to the crux of your argument. Look, FY24, look, a lot of these, will start to show up in numbers. See, what happens to a typical capex project is it first depresses your earnings for a bit, right? So there is already that pressure which comes because the financing cost comes in the while it goes into balance sheet, but at the same point in time, some of it starts to depress the EBITDA as well on occasion, right? And then it starts to show up after that. So you have to kind of discount 18 months of earnings anyway, right? On top of that, we are coming out of a cycle which has not been great. So, cyclically also earnings are not even in a mid-cycle scenario. They may be early cycle or even, reaching mid-cycle. So there is a potential that earnings goes up. So now, I know we don't propagate investing in FY25 earnings, but that is one thing to think about as to where this is going. So from that perspective, you are a bit early, yes, but you are early into something which has a higher probability of conversion. What we would call earnings visibility is a bit better. So in that sense, and you're investing in good companies. You see what is in our model portfolio, like Larsen & Toubro, Siemens, Cummins, or Capex in a different way is Ultratech Cement, right? Or for that matter, if you look at the chemicals story, we have Aether Industries in there, we have Aarti in there, we have Navin Fluorine in there. These are all companies which are anyway rock solid, right? These are companies we like anyway. And on top of that is the acceleration that you see on the revenue line. So in every cycle, including this one, there are sectors where the market wants to pay for Capex. There will be companies even today where you would announce Capex and nothing happens to the stock because you don't have visibility on the longer term drivers for that, whether it's China plus one, whether it's import substitution, whatever it may be. But in these ones, we see that, which is why we believe that, even if it's expensive, you might as well get a foothold in the door. You start investing. The market sees some kind of correction. You keep doing that as you go and kind of build larger positions in this, well over the benchmark that they have in the Nifty.
Got it. Unmesh, a follow-up and a debate on discretionary. I heard you say that you are not present there or you don't maybe like that theme as much. I speak to hotel, and I'm sure you do too, hotel companies, QSRs, restaurants, travel or aggregators. All of them are talking of rock solid demand and very little supply created over the last 2 or 3 or 4 years. Yeah. Why is it not a good theme to play?
So, okay. The answer is, the answer is twofold. Okay. One is that it's not like you would be underweight everything. Okay. As a basket, we are underweight.
Okay.
So that's the starting point, right? The second is that within that, there are 3 things which have happened. See, we don't cover any of the hotels, but at least I get the drift of what you're trying to say. See, this whole revenge consumption thing, right? So unfortunately, what's happened is that in a bid to justify valuations which are like 40, 50x, it's become regular, right? One of my analysts said that I'm upgrading the number from 44 to 48x. So, but then 44 itself is a point at which, maybe it just makes me sound too old or whatever. I don't know. But, when you're investing at 44, right, you need to think.
Sure.
I'm not saying you don't do it. That's not the point, right? Siemens is 44 times and it's in a model portfolio. So, aisa nahi hai. But the point is that how much of the revenge consumption are you extrapolating?
Mm-hmm.
And I can see that there are signs of that happening because see, there is it's a reverse kind of psychology. Something's 44 times, you want to buy it because you can see the numbers come through.
Yeah.
These numbers were priced in last year. Okay. Now that number is going to taper off, and yet the ratio is basis the growth which was delivered from last year to next year. In a technical sense, what happens is that when you do a price earnings growth multiple, which is how most people are. See, they do a DCF or a price earnings growth. If you see the way, nobody is able to justify any of this on price PE. So what we end up doing is that we put a price equity growth multiple, right? And the growth is a number that, is something that is suspect because you should take at least 3 to 5 year earnings growth. You put that into number, you find, let's say, 15, 18%. You're trading at 45. Okay. If it's a rock solid negative working capital, see, Hindustan Lever, right? While we are underweight in our model portfolio, but it's effectively taking money out of its system and paying to the shareholder. There is no capital involved. There's more than 100% ROE incrementally. All of that is there. But if you look at the discretionary, that's not the case. So you are effectively ending up paying 3 times for growth which has been delivered last year, not next year. So in that context, not comfortable. Okay. Having said that, we do have names in there. It's not like we don't have discretionary names in our model portfolio. Aditya Birla Fashion is there, which is where we think that, there is a back to office, all of these types of things. I've been buying shirts this year, that type of theme going, and Crompton Consumers in there. So we do have names, but it's very, very, very selective.
My final question. The space that is debated the most this year, no prize for guessing, information technology. What's your thought there?
Yeah, so IT has been a tough one. Okay, so one is I think through the comments what I've been making, I think you quite understand my view on the new age technology stocks, right? I think that's where the biggest issue is. I continue to believe that, right? Because I'm breaking up IT into two, because there's new age and then there is what is services, right?
Services.
Not old age, so as to speak, but yeah. So new age, look, at the highest end of the risk curve, I believe that, and we have started to see some of the behavior in the private market. We know that there is stress.
Right.
Okay. It is going to get worse. I can feel it. I don't know how to justify, because see, not a lot of the information is available easily, because listed companies have these quarterly calls, but unlisted don't. But you can see that there is a lot of M&A happening, a lot of private equity trying to exit, a lot of stock being dumped from here to there and all of that. And then finally questions being asked around whether there is cash flow or not. Okay. And usually, they're not bad people and all that. But what happens is that whenever you get into such a high stress environment, which is what we saw in infrastructure in 2008 or real estate in 2011-12, is that you start making mistakes.
Sure.
Okay. And those can be mistakes of, operations or governance, whatever. So we'll see some problem there. So we are away from that. You see, there is nothing in our model portfolio with that. We don't like that space. There are some individual companies we like, but other than that, nothing. Now, coming to IT services, we've done a very nice report, actually, which got a lot of traction roughly a month ago on the drivers for demand. Okay. And what's interesting to note is that we seem to have come to the conclusion that despite, again, the death knell being sounded on the sector every time, you think deglobalization is happening, India somehow continues to do extremely well. We do not believe that thesis will stop. Okay, so whether it's cloud adoption, whether it is digitization, whether it is, and Indian companies have been going and investing abroad in capacities and all of that happening, right? And on top of that is, geopolitically, India seems to be now slightly better off than it was as compared to some of the other countries with the West. Okay, the UK wants to do an FTA with us. There is the US, that type of thing. So necessarily long term, we think we'll be okay. In that sense, demand is a bit better than we thought, and which is why we led to some of this. Having said that, the valuations and the volatility in the currency are the two issues that we are facing right now. And while we believe that over the medium term, which is 2 to 3 years, demand will still come up at the same number that we think, in the interim, the questions about whether the demand is coming through or not will happen because of what is happening in the turmoil especially in the European region, and to some extent in the US. So with the US kind of slowing down, with Europe having its own problems, does discretionary spend go up or not? On a CAGR basis, at the end of 3 years, we think we'll be fine. But in the interim, there will be problems. And the valuations, again, are not supporting that much. So in that context, and in the currency, what's happened is that, with the dollar index going where it is, and, India having now spent $100 billion of reserves to protect the currency, we believe that ammunition will go away. At some point in time, they'll stop intervening that much, which means you could see a slight sudden bump up in the currency, right? At some stage. I hope I'm wrong, but it looks like a very distinct possibility. So in all this context, with so much volatility, what we believe will happen is that there will be some pressure on the IT stocks in the interim. We do like Infosys over TCS on a relative basis. We have a buy on both, but we do have that on a relative value basis. So we are underweight in our model portfolio, but it's not probably as sharp and underweight as what a lot of the other participants on your shows have been saying.
Well, this was lovely, Unmesh. Thanks so much for taking the time out and being with us today. And we look forward to having you more often on our show.
Thanks, Neeraj. Thank you. Thanks for your time.
Pleasure was ours. Viewers, thanks for tuning into this leg of the Talking Point.